In this lesson, we're going to discuss retirement income. After completing this lesson, you should be able to recognize various sources of retirement income and the tax documents associated with each, explain the logic behind retirement plans as investments, distinguish between a defined benefit retirement plan and a defined contribution retirement plan, compare and contrast the taxability of various retirement income sources, identify the characteristics of a rollover, and finally, explain the taxability of disability pension income before and after retirement age has been reached. So retirement income is notoriously tricky when it comes to filing federal income taxes. There are multiple forms income can be reported on, and there are many different types of retirement plans available, and unfortunately most taxpayers don't have a firm grasp on exactly what type of plan they have. So we're going to start off this session by looking at 5 general categories of retirement that we may see at our sites. Next, we will discuss the logic behind how these plans actually work in saving money for retirement. Then we'll look a little more closely at some of the categories in particular, followed by how retirement income is actually taxed. Next, we'll spend some time looking at the actual forms retirement income can be reported on and talk about why determining what type of retirement plan a taxpayer has is important. And finally, we'll end this session by looking at 2 special cases of retirement income and how to handle each on the tax return. You may have noticed that this is only part 1 of retirement income. There is a lot that you need to know about this subject, so in the next session, we're going to continue our discussion talking about a few additional special cases that you may encounter while working at the tax site. But first, let's begin by looking at our 5 general categories of retirement income. So the first one you've already seen, we've already talked about it. It's called Social Security benefits. The second is called defined benefit retirement plans. The third is defined contribution retirement plans. Next we have railroad retirement plans. And then finally we have individual retirement plans. Now, Social Security benefits are going to be government funded. It's a little misleading. They're government funded, but they're actually funded through your payroll taxes, the FICA taxes, which we have already discussed. Defined benefit plans are going to be employer funded. Defined contribution plans are employer sponsored, not particularly employer funded, although we will talk about how employers do contribute to these plans often. We have railroad retirement plans, which are government funded. And then we have individual retirement plans, which are going to be entirely taxpayer funded, or at least the ones that we're going to talk about. Now, some different types of defined benefit retirement plans that we may see. Pensions. When we refer to pensions, we're generally talking about a defined benefit retirement plan. Now, civil service employees, they all have defined benefit retirement plans, so we'll have civil service plans. And then some annuities. Annuities can be defined benefit retirement plans. Also, we have in the defined contribution retirement plans, in that category we have what's called a 401k, which you may have heard of. We also have a 403b plan, and then we have, again, some annuities can be considered defined contribution retirement plans. Individual retirement plans, we have what's called an IRA, individual retirement arrangement, that's what that stands for, and then a Roth IRA. Of course, there are some other ones that exist. Those are the 2 that we will primarily be concerned with. Let's talk now about Social Security benefits. Now, of course, we have already discussed this in Unit 1 and how to report it on the tax return, but I wanted to go ahead and mention it again since it is primarily a source of retirement income, although it does also provide benefits for survivors and disability. So many of our taxpayers will have Social Security benefits as their only form of income post-retirement. However, Social Security benefits are generally not designed to cover all living expenses, only to supplement them. Unfortunately, many of our Save First taxpayers will only have Social Security benefits as their only source of retirement. So you will see many taxpayers come in who may be in the post-retirement age and they do have a part-time job in addition to their Social Security benefits. That's often because those Social Security benefits are just not enough to cover expenses in retirement. All right, let's talk now about defined benefit plans. Defined benefit plans are an older, more traditional type of pension plan. They have been around for a long time. Workers' retirement benefits are calculated and thus defined, which is where it gets its name, by a formula that takes into account years of service and salary history. So essentially, the longer that a person has worked at a company and the greater their salary over the time, that's going to make their defined benefit pension plan higher. So there's a specific formula that most of them use that reach that point, but those two things are what they take into account to define that plan.
In a defined benefit plan, the employer controls the plan and guarantees that the employee will receive a certain amount of retirement compensation every month. Now, most employees under a defined benefit plan do not have to contribute any portion of their salary to the plan. There are some exceptions to that. Some employees do contribute to a defined benefit plan. However, most of the time, employees do not have to contribute any portion of their salary to the plan. It's normally funded by the employer. Sometimes you will hear a defined benefit plan referred to as a pension plan, but a pension is not always indicative of a defined benefits plan. So there are numerous rules that govern when retirees can start drawing their pension benefits under a defined benefit plan. Also, defined benefit plans are not considered very portable, and what I mean by that is if a taxpayer leaves a job and goes to work at another job under a defined benefit plan, it's not so easy for them to just decide to take their retirement plan with them. Now, of course, they still will have access to their plan at some point post-retirement, but there are other types of retirement plans that are very easily portable and that can be taken with you from one job to the next. So, who has a defined benefits plan? Well, we've already mentioned civil servants. When we talk about civil servants, we mean teachers, city employees, federal workers, etc. So not all, but many civil servants have defined benefit plans. And then there are also some older, mature corporations with stable workforces, and some of those will also have defined benefit plans.
However, as the economy's employment dynamics have shifted to workers changing jobs more frequently rather than remaining at one workplace until retirement, defined benefit plans have lost their popularity among employers. So they're not offered as often as they used to be. And in fact, many employers are now switching over to our next category, defined contribution plans. This is a more modern type of employer retirement plan. In a defined contribution plan, the employee controls the amount contributed to the plan as well as how the funds are invested. And under a defined contribution plan, the retirement benefits depend on how the fund assets perform and grow. So what happens here is that the employee contributes part of their salary to the retirement plan, and then it's invested in different mutual funds, different stocks, or other particular investments, and they control how the fund assets are invested, and thus the retirement benefits will grow depending on how those funds do. It's going to be funded primarily by the employee. However, often employers will match contributions up to a certain amount. And that's not a uniform thing. That's kind of just plan to plan and company to company determining how much actually gets put into the retirement account. So the most common type of defined contribution plan is going to be a 401k, which you may have heard of. And under a 401k, participants may elect to defer a portion of his or her gross salary via a pre-tax payroll deduction to the plan. Those contributions can be invested at the employee's direction in select mutual funds, money market funds, annuities, or stock offered by the plan. The employee must direct contributions and investments to grow the assets adequate for retirement. So again, some examples of defined contribution plans: 401k, there's also a 403b plan, and then also some annuity contracts can be considered defined contribution plans. Next, we have railroad retirement plans. You may find it interesting that railroad retirement has their own category. There is a reason for this, but it's primarily administered by the Railroad Retirement Board. These particular plans provide benefits to eligible employees of the railroad industry and their families. The Railroad Retirement Program is closely tied to the Social Security program. And under railroad retirement benefits, there are two different types of benefits. So we have first Tier 1 benefits. These closely resemble Social Security benefits and will actually be reported on the tax return similarly as Social Security. Tier 2 benefits closely resemble a defined benefit pension plan and will also be reported on the tax return similarly. Railroad retirement benefits are going to actually be reported on two separate tax forms. We're not going to discuss those in this session. We will discuss those in the next session, but just know that those are reported on two separate tax forms, so there will be two different places that we actually have to put it on the tax return. Our final category of retirement plan are individual retirement plans. So these are investing tools used by individual taxpayers to earmark their funds that they have earned for retirement savings. Now, there are several different types of individual retirement plans. We are going to primarily discuss the traditional IRA. We will also talk a little bit more about the Roth IRA in the next session. Individual retirement plans are established by individual taxpayers who are allowed to contribute 100% of compensation or self-employment income up to a certain dollar amount each year. So with these plans, a taxpayer can take what they have earned, they can put them in to these plans up to a certain amount every tax year. Now, individual retirement plans offer numerous tax benefits. So for example, contributions to a traditional IRA can actually be taken as an adjustment to income dependent on certain conditions. And we'll talk about that when we get to the adjustment section. In general, the eventual withdrawal from an IRA is going to be taxed as income, including capital gains on the investment. So much like a defined contribution plan, the money that is put into these individual retirement plans, they will be invested and it's going to grow over time. Now, because income is likely to be lower after retirement, the tax rate may actually be lower, which actually does offer a little bit more of a tax benefit. And we'll talk about how that works a little bit more closely later on in the session. Combined with potential tax savings at the time of contributions, IRAs can be very valuable tax management tools for individuals. I'm an advocate of everyone having an IRA. We'll talk more about that in our group training sessions, but IRAs are great investing tools for retirement. Also, depending on income, an individual might actually be able to fit into a lower tax bracket during his or her working years because of that adjustment to income from contributions. Again, we'll discuss that adjustment a little bit more in the adjustments training later on in Unit 2. So before we move on to talking about the logic behind how retirement plans actually work, let's just talk about some general terms that we need to know when discussing retirement income. I've already referred to some of these, but I just want to make sure that you have a firm grasp on these particular terms. So first of all, we have contributions. This seems fairly obvious, but just in case you're not sure, a contribution is what is made to a retirement plan from an employee and or an employer, depending on the type of plan. Now, we've already talked a little bit about pre-tax benefits in an earlier lesson, but when it comes to retirement, a pre-tax contribution is any contribution that is made to a retirement account before federal taxes are calculated. So the employee did not actually pay taxes on this particular money at the time of the contribution. Also, we have a post-tax contribution. So any contribution made to a retirement account after federal taxes have been calculated are considered a post-tax contribution. And so what this means is that the employee has already paid taxes on this money at the time of the contribution. Next, we have distributions. When we're talking about distributions in retirement, we're talking about the withdrawal of money from a retirement account paid to the owner of the account. So you as the taxpayer, once you reach retirement age, you decide you want to take a distribution from your retirement account. That is a distribution. Next, we have rollovers, which we will discuss more at the end of this session. But a rollover is a transfer of the holdings of one retirement account to another without suffering tax consequences. So, for an example, when an employee moves from company A to company B, and they have a more portable retirement plan, they can actually roll over that amount of money from company A to their retirement plan at company B, or another investing tool. So we'll talk about that more at the end of the session. The next term we have is tax deferred. Tax deferred simply means that investment earnings in a retirement account, such as interest, dividends, or capital gains that accumulate tax-free in the account until the investor withdraws them from the account. All right, so that would be money that is earned actually in the account. You're not paying taxes on them as they are actually earned throughout the years. You pay taxes on them when they're actually withdrawn from the account in retirement. And along those lines, we have interest earned. Most retirement plans invested in mutual funds, stocks, bonds, real estate, etc. So the contributions placed in those accounts, they earn interest in these types of plans.
Next, let's talk about the logic behind how retirement plans actually work. Now, you may already have a pretty good idea of this at this point, just from what we've talked about this far, but I want to go ahead and lay it out just so we understand how everything actually works. Now, essentially, retirement plans are investments. Okay, so we put them into investment accounts, stocks, mutual funds, etc. The money's placed into a retirement savings account, and it will grow over time, earning a moderate amount of interest. So what this looks like in practice is, let's say that in 1980, you put in a particular amount. Well, hopefully, in the current tax year, those contributions that have been put into the retirement account will have earned some interest, and the idea is that you will have more in your account than what you started with. So, when an employee retires, he or she will take or receive distributions from their retirement account on a regular basis. These distributions are going to include the portion originally contributed, either as funded by the employer or the employee, plus the interest that was earned in the account. Now, the idea is that the employee will have enough money in their retirement account or defined benefit pension plan to take or receive regular distributions from retirement until death. So that's kind of the logic behind how the retirement plans work. They're investments, they grow over time with interest earned, and then when the taxpayer retires, they start to receive it from their plan, they start to withdraw it from their particular account, and the idea is that they will have enough to cover them from the time they retire until they pass away. Alright, so next let's talk a little bit more about defined benefit and defined contribution plans specifically.
So in this section, I'm just going to talk a little bit more about the history of these and why there has been a shift from defined benefit plans to defined contribution plans. So more companies in recent decades have begun phasing out defined benefit plans in favor of defined contribution plans. And so let's talk about why. Defined benefit retirement plans tend to afford employees a greater retirement benefit than what employees can expect to receive through other retirement schemes, particularly if the employees live for a long period of time following retirement. So the thing about defined benefit plans is that you are guaranteed a certain amount of money until you die after retirement. Again, it's based on the employee history, years of service, and the salary history that you had while working for the company, but the amount that you receive is going to be guaranteed from month to month when you leave and retire from your job. Also, defined benefit plans place the investment risk associated with market fluctuations upon the employer instead of the employee. So because the employer funds the pension plan, the defined benefit plan, they are responsible for how the money that goes into the account are actually invested. And the investment decision-making responsibility is fully upon the employer instead of the employee. The employee has nothing to do with how the investments are managed, what kind of accounts they go into. That burden is placed entirely on the employer. So corporations typically end up saving a significant amount of money by switching their defined benefit plan scheme to a defined contribution plan scheme because the benefits afforded by defined contribution plans tend to be lower than defined benefit plans. The burden of investment assets to grow the retirement account thus shifts to the employee with a defined contribution plan. So if you'll remember, as we just discussed, the employee is going to be responsible with a defined contribution plan for directing how those investments are managed, what type of stocks, mutual funds that they are placed into, and thus how the asset actually grows over time. With defined benefit plans, those are entirely upon the employer, and it tends to take up more time for the employer, takes away time from other different types of activities that they should be focusing on with their particular industry. And so over time, defined benefit plans have become less popular and defined contribution plans have become more popular with employees. Let's return now to our categories: defined benefit plans, defined contribution, railroad retirement, individual retirement, and Social Security benefits. And let's talk a little bit more about each individually, some different notes about each one, about how they're taxed and why it's important for us to know that. All right. So let's start first with Social Security benefits. So as we talked about in a previous lesson, Social Security benefits are administered by the Social Security Administration to eligible retired workers. You can go back and watch that lesson to learn more about Social Security, but just as a reminder, Social Security benefits are funded by payroll taxes of the current workforce. So you'll remember, unlike many of these other retirement plans, Social Security benefits are not linked to an individual retirement account for an employee. So when you pay those payroll taxes, they're not going to an account that has your name on it that you can thus draw from when you retire. That's not how it works. Social Security benefits they're funded by payroll taxes of the actual current workforce. And remember that Social Security benefits are usually not going to be taxable if they are the only source of income for a taxpayer. There are a couple of exceptions to that, which you can look in the publication 4012 to find, but in general, usually they are not taxable if they're the only source of income. Next, with defined benefit retirement plans, these are, again, fully funded by the employer. They will be a monthly set amount based on salary history and years of service. The employee will pay taxes on those distributions once they are received after retirement. So they won't be paying any type of taxes on that amount prior to retirement or prior to withdrawing from the account. They will pay taxes on payments received. Next, we have defined contribution retirement plans. Again, these are employer-sponsored. They're not funded primarily by the employer, but they are employer-sponsored. And in these, the employee contributes a portion of their gross salary through a pre-tax deduction. So they offer benefits by allowing the employee to defer taxes on that amount. And we'll talk more about how that works in just a moment. Next, with railroad retirement plans, again, those are administered by the Railroad Retirement Board, and they are broken into two parts, Tier 1 and Tier 2 benefits, and they are taxed similarly to Social Security and defined benefit plans, respectively. So we'll talk more about that in Session 2. Finally, with individual retirement plans, they are funded by individual taxpayers. They are generally not associated with an employer, although again there are some exceptions to that, but the ones that we're going to discuss are funded by individual taxpayers. Like defined contribution plans, they do offer tax benefits by allowing the employee to defer some of their taxes, by allowing them to take an adjustment to income and thus potentially putting them into a lower tax bracket. And again, we'll talk more about that in a moment. Next, let's talk about how distributions from a retirement account that a taxpayer contributes to are taxed. So this will be talking about defined contribution plans, also about individual retirement arrangements. It's important to determine how the contributions to the retirement account were actually made when we determine how the distributions are going to be taxed. So let's go back to our discussion of pre-tax versus post-tax. So if you'll remember, pre-tax deductions mean that the employee did not pay taxes on the money at the time it was contributed to the account. All right, so those pre-tax deductions, they have no federal taxes taken out. Therefore, we will have to account for that. Post-tax deductions, however, mean that the employee paid taxes on the money at the time it was contributed to the account.
So remember, as we talked about earlier, retirement plans are investments. Money is going to be placed into retirement savings accounts and will grow over time, earning a moderate amount of interest until a taxpayer retires and starts taking money from that account. Now, tax liability for a retirement account distribution is going to be based on what amount has already been taxed. So, if the tax was already paid on a contribution before placed into an account, tax won't have to be paid again on that particular amount. However, part of the advantage of retirement plans is that money invested can earn interest. So if the interest accumulates in a retirement account, taxes will have to be paid on that interest amount received when the taxpayer takes it as a distribution. So let's look at a visual here to give us more perspective.
If all the money in the account was contributed pre-tax, all right, so there has been no taxes paid whatsoever on the money that was contributed into the account, that means that the original contribution plus the interest that is earned in the account are all going to be fully taxable when taken as a distribution. However, if all the money in the account was contributed post-tax, so again, post-tax meaning that all of the funds contributed to the account have already had taxes paid on them. So in this case, with the original contribution and the interest earned, the taxpayer would only need to pay taxes on the interest earned whenever they take it as a distribution. So the IRS is not going to make you pay taxes on the original contribution twice. You're only going to have to pay taxes on the interest earned amount when you withdraw it as a distribution, making this particular retirement distribution partially taxable. So just to sum up here, you paid tax on the original contribution, but when that amount is invested and earns interest, that interest is brand new income. And so tax will have to be paid on that amount. There is an exception to this that's a little bit more confusing, so we're going to just table that for now and come back and talk about Roth contributions in part 2 of retirement income. But in general, you're going to have to pay taxes on that interest earned if it was contributed post-tax.
Now let's talk about some common types of retirement plans. We've already talked about many of these, but I just want to have these all in one place so you can see the different types of retirement plans that we may see at our tax site. So we've already talked about pensions. Pensions are a series of payments for past work, again based on salary history and years of service. These will commonly be considered defined benefit plans. However, sometimes they are defined contribution plans. Next, we have a 401k plan. Under a 401k plan, a part of the employee's gross salary is placed in a retirement plan on a pre-tax basis, which once again means it's not subject to income tax until the employee receives it as a distribution from the retirement account. Now, a 401k plan is going to be considered a defined contribution plan.
Then we have individual retirement arrangements. Also sometimes called individual retirement accounts. We'll use those interchangeably, but those are IRAs. IRAs are a personal savings plan that offers tax advantages to set aside money for retirement. In these types of plans, earnings generally accumulate tax-free until withdrawn, as we just discussed. And there are 4 types of individual retirement arrangements. The one that we're going to see the most is a traditional IRA, and that's really the only one that's in scope for us. There is also a Roth IRA, which is usually out of scope, but it is in scope under certain conditions, which we will talk about in part 2 of this session. There's also a simple and SEP, individual retirement arrangement. Those are somewhat tied to employers, and therefore they're going to be out of scope for us. They are complicated, and we just can't deal with those at our sites. I do want to spend a minute here talking about how IRAs work and how they help bring about tax benefits to the taxpayer. So let's just use an example here. We're gonna call this guy Mike. Mike has $50,000 that he earned last year. So he earned $50,000, and if you'll remember back to our first session about laying the foundation, we talked about progressive tax rates. An effective tax rate just means how much of his income is he actually being taxed on. So you can kind of average out his marginal tax rate to get an effective tax rate of 17%. So essentially, Mike is going to pay 17% of his $50,000 in federal taxes for the year. So that's about $8,500, right? However, let's say that Mike decides that he wants to have an individual retirement account. So he signs up for a traditional IRA. He decides to contribute a portion of his salary into the retirement account at the end of the year. So in this account, he puts $5,000. He puts $5,000 into the account, and thus he's going to put that away, and he's not going to have to worry about the taxes on that $5,000 at this time. So his taxable income is going to actually now be $45,000, not $50,000. So $45,000, his effective tax rate now lowers a little bit to about 16%. And so now he's going to be paying about $7,200 in taxes this year instead of that $8,500 that he paid before. That's $1,300 less than if he had not contributed to his IRA. Now, over time, that $5,000 is going to continue to grow tax deferred over the next, let's say, 40 years. Mike probably would have contributed more into the account, and over time, he's going to earn some interest on it. And when Mike retires and starts taking distributions from this account, he's then going to be taxed from that account, and probably at a lower rate. Likely because his total income will be less than what it was when he was working. So let's just say that he decides to only take out $20,000 one year. His effective tax rate is going to be much, much lower. And so he had two benefits here. He had one where he was able to lower his effective tax rate and thus pay less in taxes. And then when he takes this money out at retirement, he's also going to pay less on that because he's going to be in a lower tax bracket. Individual retirement accounts are very, very beneficial when it comes to taxes and helping to save some money and actually end up paying less overall throughout the employee's life. Let's talk now about different retirement forms that retirement income can be reported on. There are a number of them. So we're going to talk primarily today about the Form 1099-R. That will be the most common that we'll see. A Form 1099-R is distributions from pensions, annuities, retirement or profit sharing plans, IRAs, insurance contracts, etc. So there's lots of different things that are reported on this particular form. Then there's also a form called the Form CSA 1099-R. This is a statement of annuity paid, and these are typically given to civil service employees for their retirement payments. Then we have a Form CSF 1099-R. This is a statement of survivor annuity paid to survivors. And then finally, we have the Form RRB 1099-R, which is annuities or pensions by the Railroad Retirement Board. And we're going to talk more specifically about that 1099-R for the Railroad Retirement Board in Part 2. Now you'll notice that these all have 1099-R in their title, so it still should be pretty easy to recognize if a taxpayer has retirement, but they do look different, but they generally report the same or similar information on them. So let's talk first about the Form 1099-R. We're going to look at each one of the boxes that we will deal with individually in more detail in a second, but let's just get a quick overview of each section before we move on. So box 1 is going to show the gross distribution. So this is going to be the total amount the taxpayer received during the tax year. Box 2A is going to report the taxable amount. So this is the part of the distribution that is considered the taxable portion. Sometimes this box may be blank. And we will deal with what to do if the taxable amount is not determined in the next retirement lesson. But for now, we're just going to deal with what happens if there is an amount in box 2A. Box 2B shows two different boxes. The first one, taxable amount not determined. If this first box is checked, the payer was unable to determine the taxable amount. And again, we'll deal with what happens when this is blank in the next lesson. If the second box is checked, total distribution, then the distribution was a total distribution that closed out the retirement account. Box 4 shows the federal income tax withheld on the distribution. And box 7 is going to show the distribution code that identifies the type of distribution received. The second side there, IRA SEP simple, if this box is checked, the distribution is going to be from either a traditional IRA, an SEP, or a simple account. Now, depending on what type of plan the distribution is from, there might be an amount here shown for total employee contributions, showing the employee's total investment in the plan. This is going to be used in helping us calculate the taxable portion if box 2A is blank in part 2 that we'll talk about later. Boxes 12 through 14 are going to show state income tax if there was any withheld from the distribution. And these boxes may show the amount subject to state tax and also how much was withheld. So let's talk now a little bit more in detail about the individual boxes. First, we have gross distribution reported in box 1. Again, it's going to show the total amount received during the tax year. The amount listed in this box could be a rollover. Again, we'll talk about rollover a little bit later. It could be that a taxpayer may have received the distribution as periodic payments throughout the year, or it could have been that they got them non-periodically. They could have withdrawn from their retirement account at certain times. Or it could be that this amount is a total distribution. So it closed out a retirement account. It was a one-time payment that they received from the retirement account to close it out. The taxable amount reported in box 2A is going to show the total amount that is subject to federal income tax in the tax year. Now again, this box might be blank and will require an additional computation to determine the taxable amount. Again, we'll discuss that in the next lesson. So remember that it's possible that a gross distribution reported in box 1 might be fully taxable or just partially taxable. And again, we talked about that earlier. That is due to how the contributions were made, either pre-tax or post-tax. So it's very possible that that gross distribution, not all of it will be taxable, which is why this box exists. The next box, taxable amount not determined and total distribution in 2B. Taxable amount not determined indicates that the payer was unable to determine the taxable amount. So if this box is checked, box 2A also should be blank. Total distribution indicates that the distribution was a total distribution that closed out the account. Box 4, federal income tax withheld, again reports the amount of federal income tax that was withheld on the gross distribution. And similar to the Form W-2, this amount is going to be determined by filling out a Form W-4P. So you'll see here it looks very, very similar to the Form W-4, and it actually has the same questions that gives you personal allowances, is thus going to determine how much is going to be withheld from the distribution. The next box, the distribution codes box and the IRA SEP simple box reported in box 7 is extremely important, and you're going to become familiar with many of the codes listed in this box. So the distribution code identify the type of distribution received, and these codes are going to indicate whether or not it is in scope for us at VITA, because only certain distribution types are going to be in scope for us. So let's talk about what some of the different codes are. And again, these codes don't identify what type of retirement plan it is. So these codes don't say, oh, this is a defined benefit plan or this is a defined contribution plan. These just identify how the taxpayer received it, and whether or not we need to do anything additionally with the retirement income. So some of the most common ones we'll see are Code 1. Code 1 indicates that this distribution was an early distribution and then there is no known exception. In most cases, 1 will be in this distribution code box if a taxpayer withdrew distributions from the account before age 59 and a half. In most cases, if they do that, it is considered an early distribution and there might be an additional tax that will apply. We'll talk about that a little bit more in part 2. Code 2 is an early distribution. However, there is an exception that applies. We'll talk about what those are later. Again, that would be an early distribution before age 59 and a half. If there's Code 3, it indicates that this is a disability payment. We're going to talk more about that at the end of this lesson, so just table that for now. Code 4 indicates that this is a distribution after the death of the taxpayer. So this could be that a taxpayer's surviving spouse is receiving this as a distribution. Code 7 will be the most common that we'll see. It's just a normal distribution. Most taxpayers will have 7 in this box, and there won't be anything really weird that we need to worry about. It's just a normal distribution after retirement. Code B could indicate that this is a designated Roth account distribution. We'll talk about that more later, so don't worry about that for now. Code G indicates that this is a rollover. Now, there are many, many more codes that could be in this box. These are the ones that we're primarily going to concern ourselves with and that are in scope for us. However, you can see your Publication 4012 in the Income tab for a full list of Box 7 distribution codes, including ones that are out of scope, but it will indicate which ones are in scope for us. So if you ever see a distribution code that is unfamiliar to you, you must always, always, always go check the Publication 4012 and verify that it is in scope. And I promise you want to do that because, as you can probably have gathered from at this point in the lesson, retirement is complicated and you don't need to be trying to report a type of retirement that you don't know what needs to be done with it. The second part of this box 7 is the IRA SEP Simple box. This is going to indicate that the distribution was from a traditional IRA, an SEP, or simple retirement account. Now, you'll remember I mentioned earlier that only traditional IRAs are in scope for VITA. If a taxpayer has this checked, you need to verify with them that the amount distributed here was from a traditional IRA. Unfortunately, taxpayers often don't know. However, we don't see a lot of IRAs, so if you do see this, hopefully the taxpayer will know. But if they do not, they're going to need to figure out if it is from a traditional IRA before we can report it. The next box, total employee contributions, reported in box 9B. These are for certain plans. An amount may be listed here showing the taxpayer's contributions to that plan. We're not going to concern ourselves with this at this point, but just know that this amount is used to help determine the taxable amount if box 2A is blank. Let's move on now to talk a little bit more about the Form CSA 1099-R, which is a statement of annuity paid. You'll see that it looks a lot different from the Form 1099-R. However, you'll see that it reports the same information with the same actual numbers as well. So box 1, gross distribution, box 2A, taxable amount, box 4, federal income tax withheld. On the other side, we have box 7, distribution code, and box 9B, total employee contributions. You also may see something here in box 5 for employee contributions or designated Roth contributions.
In general, anything that you see on the tax form needs to be transferred into the tax software to the appropriate box. So as I mentioned on this form, the CSA 1099-R Statement of Annuity Paid, it's going to provide the same information as the Form 1099-R, but these are going to be issued to civil service employees. Now, if you'll remember, as I mentioned before, many civil service employees will have defined benefit retirement plans, so just keep that in the back of your mind. And we're going to talk about why that's important in a moment. Next, we have Form CSF 1099-R, which is a Statement of Survivor Annuity Paid. You'll see it looks very similar to the CSA 1099-R. Again, this form reports the same information as the CSA and Form 1099-R. This is going to be issued to survivors of civil service employees if the employee elected to have a survivor annuity for their spouse and or their children. So you may see this for the wife of a teacher or the husband of a federal employee of some sort. They're going to be issued this if the employee elected to have a survivor annuity for the spouse or the children. Once again, remember, civil service employees with a CSA or CSF form will have defined benefit retirement plans. So we're actually going to talk now about why this is so important, why it's so important to determine what category of retirement plan a taxpayer has.
So again, when I'm talking about the categories, I'm talking about the Social Security, defined benefit, defined contribution, railroad retirement, individual retirement plans. So we're going to talk now about why it actually is important. So the reason it's so important is that some retirement plans are not taxable on the state level. I'm going to say that one more time. Some retirement plans are not taxable on the state level.
It's extremely important to determine what type of retirement plan a taxpayer has because it's going to change how the form is addressed in the tax software. So we can't just put the form in and hope for the best. We really need to determine what type of retirement plan the taxpayer has, what category it's in, so that we can determine how to enter it into our tax software. So, for example, in the state of Alabama, these retirement categories are not taxable in the state. So we've already talked about how Social Security benefits are non-taxable in Alabama if you watch the Alabama lesson, but also defined benefit retirement plans and railroad retirement plans, as well as certain retirement systems, are not taxable in Alabama. So unless we determine that a taxpayer has one of those plans, we can't assume the plan is exempt from tax. In the state of Mississippi, most retirement plans, I say all retirement plans, but there are some exceptions, are not taxable in Mississippi at all. So if you have a retirement plan from Mississippi and you're being taxed in that state, in general, most retirement plans will not be taxable. In South Carolina, Social Security, railroad retirement, and disability retirement are not taxable in the state. Note that for disability retirement income, certain conditions apply for this income to be tax exempt. Now, other qualified retirement may be deducted up to a certain amount in South Carolina, and that amount will depend on age. So a South Carolina taxpayer can deduct up to $3,000 if they're under age 65, and up to $10,000 if they're 65 or older. So as you can see, it's really important to determine what type of plan that a taxpayer has because there are very different rules depending on what state you're preparing the tax return in. So we've talked a lot about the different categories of retirement plans and why it's important. So let's talk a little bit more about how to determine what type the plan is.
So what if the taxpayer doesn't know what type of plan they have? And you will encounter this a lot when a taxpayer doesn't know what type of retirement plan they have, unfortunately. As you can see, it's very complicated, and if it's complicated to us, it's most certainly going to be complicated to the taxpayer when they sit down with you. Now, unfortunately, the Form 1099-R often doesn't make clear what type of plan the distribution is from. So it's going to take just some knowledge on our part, some using of the resources that we have, as well as asking the taxpayer certain questions to help us determine what type of plan they have. So let's talk about each one of these and how we can determine it. Social Security benefits, we already know how to determine if it's Social Security benefits. It's just going to be reported on an SSA 1099. Very easy to determine that. We already know how to report that as well. Defined benefit retirement plans, however, those are not clearly evident from the 1099-R. It's going to require asking taxpayers certain questions and also consulting the many resources that you have available. It also may require calling the administrator of the plan. And we may have to get to that point where you have to just call the administrator of the plan. Much like the defined benefit plan, the defined contribution plan, again, not clearly evident from the 1099-R and will require asking taxpayer questions and consulting resources. Railroad retirement plans, those are easy to determine because they're going to be reported on an RRB 1099 and or an RRB 1099-R. Again, we'll talk about both of those forms in the next session. And then finally, individual retirement plans. We're going to know if it's an IRA because that IRA box will be checked on the Form 1099-R. However, we will need to verify that it is a traditional IRA to make sure it's in scope for us. So you can see here, 3 of them are pretty easy to determine. We're going to spend the majority of our time here talking about how to distinguish between a defined benefit retirement plan and a defined contribution retirement plan. So again, it is not up to you to decide what type of plan a taxpayer has. You don't need to just guess. That is not a good idea. It is not doing your due diligence as the preparer, 1, and 2, you could be hurting the taxpayer by guessing. So to determine if a retirement plan is a defined benefits or defined contributions plans, you have a number of resources, the first of which is the defined benefit plan list that will be included in your site coordinator manual. So you can open up the manuals that you currently have. It has the most up-to-date list that we have, and there are some very specific plans, 9 or 10 pages worth of specific defined benefit plans that you can look and see, is this a defined benefit plan? You can call the company that administers the plan. If you can't find it in that site coordinator manual, you could have the taxpayer do this, or they may want you to help with that. You can call the company directly that administers the plan and ask them, is this a defined benefits plan or is this a defined contributions plan? You can also try to contact the particular state Department of Revenue wherever you are. They hopefully will be able to help you, although often they are not as helpful as you would like. The site coordinator manuals will actually probably be more useful in determining that than calling the Department of Revenue, but if all else fails, it doesn't hurt to call them to find out. You could also call the IRS, although getting through to the IRS is generally harder, but you could call them if you needed to. Finally, you can ask for a summary plan description. We're going to talk specifically about what that is here in a moment.
So, as has been mentioned many times in this lesson, retired civil servants with a CSA or a CSF will have a defined benefit plan. So, teachers in public school, city employees, etc., these people with civil service retirement system plans will have defined benefit plans. Now, 401ks are not defined benefits. This is a common mistake that we've seen at our tax sites. 401ks, again, are not defined benefits. They are defined contributions. Now, to determine if it's a defined benefit plan or defined contribution plan, you can ask the taxpayer the following questions to help you reach a decision. So you can ask the taxpayer if they receive the same amount every pay period. Now, if they say yes, it's likely going to be a defined benefit plan, but not always. So remember, defined benefit plans, there is a set amount per month based on years of service and salary history, and that's typically not going to change month to month. So if they are receiving the same amount every month out of the year, then likely it'll be defined benefits, but it could also be defined contributions. You should also ask them, did your employer match your retirement contributions? So if they answer yes, it's likely going to be defined contributions because the taxpayer actually contributed to an account and the employer then matched that contribution. And then finally, you can ask, were your specific contributions placed into an investment account? If yes, then it will likely be a defined contribution plan, again, because the taxpayer was making contributions and they were being invested at the taxpayer's direction. Now, I want to ask just one of these questions. You should be asking all of these to the taxpayer to help you reach a decision about whether it's defined benefits or defined contributions. Oftentimes, from these questions and from consulting your resources, that's going to be enough. It'll make you fully confident that it is defined benefits or defined contributions. However, if you are still unclear once you reach this point, if it's not clear and the taxpayer just doesn't know and you don't know, then we can ask for a summary plan description.
And I'll be honest, at this point, it's probably going to take a lot to get this from a taxpayer, but I really think that it is worth it to have a taxpayer try to ask for this if you at all costs cannot figure out what it is. So the summary plan description is going to be a document provided by the plan administrator that includes a plain language description of important features of the plan. So for example, when the employee began to participate in the plan, how service and benefits are calculated, when benefits became vested, when payments are received and in what form, and how to file a claim for benefits. You'll notice the middle part there about how service and benefits are calculated. It's going to pretty plainly describe a defined benefit or defined contribution plan if the taxpayer isn't sure. Last resort, ask for a summary plan description. Also, even through all that, if you still can't determine it, you can most certainly call one of your supervisors to help you figure out what type of plan it is. So ideally, a taxpayer is going to have access to this summary plan description, although, again, the reality is that most are not going to bring this when they file their return, and many don't really even know what this is. But it doesn't hurt to ask if the retirement plan type cannot be easily determined, because you never know. So let's go through a few examples in helping us determine a defined benefit or defined contribution. The first one, Joe has been receiving his retirement payments for several years and has received a 1099-R. When you ask him if he knows what kind of plan it is, he says he has no idea, but he knows it is from his employment as a teacher. Is this a defined benefits or defined contributions plan? Defined benefits plan. Remember, for the millionth time, all civil servants are going to have a defined benefits plan. The next one, Maria began receiving her retirement payments this year and was issued a 1099-R. She tells you that this is being drawn from an investment account that she would contribute to and her former employer would match that contribution. Is this a defined benefits plan or defined contributions plan? Defined contributions plan because she was contributing and her employer was matching. Charles has been receiving his retirement for 7 years. Every month he receives $100. Is this a defined benefits plan or a defined contributions plan? Well, after talking to Charles and determining that he received this every month and he did not contribute anything to an account, we're going to determine that it is a defined benefits plan because he receives that same set amount each month. Now let's take a look at a couple of scenarios, a couple of video scenarios with the tax preparer and the taxpayer in helping determine if the taxpayer has a defined benefits or defined contributions plan.
Okay, so on your intake and interview form, you listed that you did have some retirement income. Do you know if that is a defined benefits or a defined contributions plan?
Darling, I have no idea.
Okay, that's okay. Most people don't, so it's completely okay. All right, so do you know where your retirement comes from?
I think it comes from work.
Okay, and did you contribute to this, or do you receive the same amount each month?
Listen here, lady. I don't know what type of language you're speaking. All I know is a 401k.
Oh, okay, perfect. That's all I needed to know. In that case, then that's going to be a defined contributions plan.
It's that simple.
Yep.
Thank you so much. You're so smart. So I see you had some retirement income last year. Do you know if your plan was a defined benefits or a defined contributions plan?
I have no idea. I'm sorry.
Well, that's all right. If you can just tell me a little bit about the plan. Where does your retirement come from?
It's from my work as a public school teacher.
Oh, great. Well, and you receive the same amount each month?
Yes. Mm-hmm.
Awesome. So that is a defined benefits plan. And let me just double check this in my handbook because I believe, yep, that is correct. You are not subject to Alabama state income tax for your retirement.
Yay! Awesome.
Hopefully now you understand why it is so important for you as the tax preparer to determine what type of retirement plan a taxpayer has. And this is not something that you just need to guess on. You need to use all of your resources, use these questions, use just your knowledge about what these different types of plans are and helping you determine so that you can make sure that it is accurately reported on the tax return. To end this session, we're going to talk now about two special cases of retirement income. rollovers, and disability pension income. First, let's talk about rollovers. Now, we mentioned this earlier when we were talking about retirement terms. So if you'll remember back to that, rollovers refer to transferring the holdings in one retirement account to another. So specifically, the retirement account is emptied and distributed to the owner, who then deposits them into a new account for reinvestment. The reason why it's so important to determine if a taxpayer has a rollover is because rollovers are tax-free distributions. So the IRS is not going to make the taxpayer pay taxes just because they withdrew it from an account and put it into another one. However, it's still going to be reported on the federal tax return because the previous retirement plan payer is going to issue the taxpayer a 1099-R for the distribution. Subsequently, that's going to be reported to the IRS, so this amount does need to be reported on the tax return. So to indicate a rollover, in box 7, you're going to see a distribution code of code G. So why do taxpayers do this? Well, the money that's being taken out of these accounts and being rolled over into a new account, it's still being saved for retirement. It's simply being rolled from one qualified retirement savings plan into another retirement savings plan, or in some cases, a taxpayer may withdraw money planning to use it for some specific purpose, but then they roll it back into the account without actually having used it. So that's why a taxpayer sometimes might actually have a rollover. So an example, Julia left her job at dog food company, but she wanted to take her 401k plan with her. So what's going to happen is that Julie is going to empty that account from her employer at dog food company. She's going to have a full tax-free distribution of that account, and then she's going to roll it over into a new qualified retirement savings plan. Finally, let's end today with disability pension income. So why would a taxpayer have disability pension income? Well, perhaps they had an accident that rendered them totally and permanently disabled. They're going to be paid disability because they're not able to work, and those disability payments might be coming from a qualified retirement pension plan. That's often how it works. An employer that offers these defined benefit plans, they will have disability payments coming from those plans before retirement age. So why is it important to determine if a taxpayer's 1099-R is for disability pension payments? The reason why it's important is that because until a taxpayer reaches the retirement age for that specific plan, the income is going to be treated like wages, even though it's coming from a retirement account, which might make the taxpayer eligible for the earned income tax credit. That's why this is incredibly important, because when we determine that a taxpayer's income comes from a disability pension plan and they have not reached retirement age yet, we're going to report it a little bit differently in our tax software. So code 3 is going to be in box 7 of the 1099-R if it's for disability. However, you still have to ask the taxpayer a couple of questions to make sure you're reporting it correctly. What that entails is asking the taxpayer if they have reached retirement age for this specific plan that this retirement distribution is coming from. If the taxpayer isn't sure if they have reached retirement age, the retirement age for that plan, they may need to consult their retirement paperwork, that summary plan description, or contact the plan manager to find out what the retirement age is. So, as you may or may not know, retirement age is not uniform from plan to plan, from employer to employer. Typically, it's around 65, but again, that's not uniform across the board. So you cannot just rely on I actually amended someone's return one year because it wasn't reported correctly, and doing the amendment on the return actually made this taxpayer eligible for the earned income credit, which got them about an additional $2,000 on that return. So that's why it's very, very, very important to make sure you are determining if a taxpayer has reached retirement age or not for that specific plan.
Now, if the taxpayer has not reached retirement age, in the tax software there's going to be a checkbox that says, check here to report on Form 1040, line 7, distribution code must be a 3. Now that box needs to be checked, and then once you check that box, you need to go back to the summary print page and verify that the amount that you just entered in on Form 1099-R is being shown on the wages line, not the retirement line. So the very simple act of checking or not checking a box can determine if this is reported correctly or not. If the taxpayer has already reached retirement age, however, so if they are over that mandated retirement age for that specific plan, you do not need to check the checkbox that I just mentioned, even though there still may be Code 3 in Box 7. So just because it's Code 3 in Box 7 doesn't mean you need to check the box. I can't emphasize that enough. So just because there is a Code 3 in Box 7 doesn't mean you need to check the box. You need to verify if the taxpayer has reached retirement age or not.
So as you can see, retirement income is very complicated. There's a lot that goes into it. Hopefully it's a little bit clearer now at the end of this lesson. However, in part 2, we're going to talk a little bit more about certain other aspects of retirement that we did not cover in this lesson. Now that you've completed this lesson, hopefully you can now recognize various sources of retirement income and tax documents associated with each, explain the logic behind retirement plans as investments, distinguish between a defined benefit retirement plan and a defined contribution retirement plan, compare and contrast the taxability of various retirement income sources, identify the characteristics of a rollover, and finally explain the taxability of disability pension income before and after retirement age has been reached. If you are having trouble with any of those objectives, I encourage you to go back to the specific sections and rewatch it and write down any questions that you may have and bring them to group training.